Hello, I'm Jessica Amir for the Finance News Network. With me today from Smarter Money Investments is Portfolio Manager Chris Joye. Hi Chris and welcome back.
Hey Jessica.
So for those who haven't heard of Smarter Money Investments, just give us a quick introduction.
We're an active Aussie fixed income fund manager. We run $3.2 billion today. 70% of that money is for institutional investors. We offer 3 core strategies. The team comprises 4 portfolio managers and 7 analysts. It's quite a large team. We own 75% of the business. We have a large family office that owns the other quarter of the business. Technically, the investment team is Coolabah Capital Investments, and we run the Smarter Money Investments portfolios.
Great, thanks Chris. And before we talk about your actual funds, just tell us about the case for investing in cash and bonds, given that we're at record low interest rate levels.
I think the first point is that by investing in cash and bonds, you're reducing the risk of capital loss. So we saw during the global financial crisis, equities fell 60%, cash and bonds performed much, much better. If you're targeting a return of about 3 to 4% above the inflation rate, over the last 40 years, the optimal portfolio would have been 60 to 70% invested in cash and bonds, with the rest in equities and property. We see in Australia, most super fund portfolios have the reverse. So they tend to be 60 to 80% in equities and very little cash and fixed income, even though the asset classes are very, very large. So if you want a stable, low risk return and you're worried about equity volatility, then there is a diversifying role for cash and fixed income.
Now to the funds. Tell us about your approach.
Some people think that as interest rates increase, that's bad for fixed income because a fixed rate bond can decline in price as rates rise. But we only invest in floating rate bonds. And so that means that as the RBA's cash rate increases, our returns will improve. We try and avoid the 3 main risks that you generally find in fixed income. So the first risk is interest rate risk, and we don't take that because we're floating rate. A second risk is called credit risk, and the vast majority of all of our portfolios are investment grade, and the average credit rating in our portfolios is in the A band, which is a very safe and highly rated outcome. The final risk in fixed income that folks will try and leverage off is liquidity risk. The way we do generate returns is through a valuation alpha. What that means is we revalue every bond in the market in Australia and globally every day, and we're looking for the cheap bonds that are paying too much interest. And when we find those securities and the market figures that they don't need to pay that excess interest or that excess spread, and the interest rate actually normalizes to our target, we actually get capital appreciation. So historically, if we look at the last 2,300 bonds we've sold, our win ratio has been 99%, and about 50 to 60% of our return has come from capital gains or valuation alpha.
Thanks Chris. So you mentioned returns. Just tell me about the products and their respective performance.
Yeah, so we offer the Smarter Money Active Cash solution that targets a return of 1 to 2% above the RBA cash rate after fees, and it's historically over the last 7 years delivered at the top end of that range and is certainly in the top decile of cash plus or short-term fixed interest products in Australia. We have a second solution called the Smarter Money Higher Income Fund. It has a slightly higher return target of up to 3% above the cash rate, and it's outperformed the active cash strategy by about 70 basis points per annum pre-fees. And then we have a new long-short credit hedge fund, and that's a leverage version of the first 2 strategies. Over the last 12 months, that has delivered about 6% pre-fees with less than 1% volatility, so very, very low volatility, quite high returns. The fees on that product are negotiable, so we have an array of different fee regimes.
And just lastly, Chris, why should someone invest with SMI in terms of their cash and bond exposure?
I think we're a very, very different manager. We're incredibly active. We're typically buying and selling bonds up to 30, 40 times a day. We tend to hold very high conviction portfolios, much more like an equities manager. So your typical bond manager might hold 500 securities, whereas we'll typically hold 40 to 80, and we're only acquiring bonds that we think are cheap and that are paying excess interest and that will deliver capital growth as well as yield.
Thank you so much, Chris Joye, for your time and for your insights.
Thanks, Jessica.
And thank you for watching.